Welcome to the Women in Impact series, also known as WinImpact. We bring together leading women in impact investing to talk about innovations and challenges for financial advisors who want to offer impact investing options. Today, we have a guest who has gone from institutional ESG investing to creating her own startup focusing on implementing systematic impact. She identifies key impact data themes she thinks will become prominent all over the world. We are honored to have Kathryn McDonald here today to share her insights. I'm Rosanna, and this is Emily.
We're your hosts for the WinImpact series, and today on episode 5, we're talking to Kathryn, co-founder and head of investments and sustainability at Radiant ESG. At Radiant ESG, Kathryn advocates for positive change in the asset management industry, using her institutional background to help inform investors, asset owners, and data providers. Prior to starting the consulting firm Radiant, Kathryn McDonald was the head of sustainable investing at Rosenberg Equities. She led the firm's ESG and impact research effort with a heavy focus on investment modeling, data vetting, thematic research, and externally oriented thought leadership. Kathryn began her career at Barra, a risk modeling firm. She's also the founder of Aquanos Collective, a company dedicated to the exploration of innovation in water infrastructure and technology, and a member of the board for the Responsible Investment Association of Australasia. Kathryn spent her childhood in Idaho, but has called California home for almost 30 years now. When not working, Kathryn can typically be found at the barn with her horse or hiking in the East Bay Hills with her husband and dog. She's an avid reader, an active supporter of several charitable causes, and a collector of Indigenous art from Australia and the American West. Kathryn, we are thrilled to have you here on our WinImpact series.
So Kathryn, in ESG Clarity, you state your vision with Radiant ESG is to create the asset management firm of the future and to compel asset owners to act in their capacity to drive purposeful change. And at the same time, you intend to help carve a path for women and minorities in financial services for generations to come. That's why you founded Radiant ESG with another woman, Heidi Kashabi Ridley, former Global Chief Executive Officer of Rosenberg Equities. Your personal commitment to what we now call ESG investing began over 30 years ago in the form of letter writing campaigns targeting companies engaged in environmental destruction, ocean pollution, and animal testing. Combined with that, you have had over 20 years of experience investing in the institutional space. In some ways, Radiant ESG certainly fits your career trajectory in sustainability, but it's a big leap from institutional investing to creating your own startup. Why did you make this pivot, and what have you learned in the process of building up Radiant ESG?
Yeah, thank you so much for having me. It's really great to be here with you this afternoon. You know, Radiant, we have started as a consulting firm, and we intended to meet this very specific need in the market, and we are ultimately interested in being back in the money management business. But you know, everything that you mentioned in terms of driving purposeful change and carving out paths for women and other underrepresented people in our business, you know, is very important to us, whether it's consulting or money management. I think it's really important to continue to emphasize that both Heidi Ridley and I come from a very traditional quant equity background. And over the course of our careers, we've really come to strongly believe in the investment merits of ESG and the investment merits of diverse teams. So when you hear us talking about ESG, ours is really an economic argument. And, you know, just to be clear, for us, that means we believe ESG is going to make us better investors, and we believe that that will translate into better returns and lower risk over time. So whether it's direct investing or consulting, you know, we really do see a need for leadership within our industry that bridges the gap that we still see that we think is present between, you know, sort of the ESG side of the house and the investment side of the house. You know, we don't see these as separate things. These are things that are, you know, kind of one and the same. And we believe that by using ESG information alongside traditional financial statement information, that's the way that we can best understand the threats and opportunities that companies will face going forward. In terms of, you asked us what we've learned so far. So far, we've learned a lot. Going from a pretty well-established business to a startup, going to a startup in the middle of a pandemic. All of this has been really incredibly eye-opening. Having to be our own IT department, that's probably been the biggest challenge so far. But the one thing I'll say that we have learned is that there is enormous support for the idea of a stepped up role for women within investment management, and the encouragement and advice that we've gotten so far since we launched the company in June has just been overwhelmingly positive, and for this we're just enormously grateful. The other thing that I'll mention, and we certainly knew it before we started the company, but it's really only been reinforced, is that there's such a wide variety of strategies out there that are labeled ESG or sustainable or responsible, and then the breadth of difference between the way reporting is done from one fund to another. It can be kind of overwhelming. And I think that, it's great that we're going to talk about ESG reporting today, because I think this can be a source of frustration. But if we change the way we do it by just a little bit, we really think that it can be a competitive strength for asset managers and advisors within their own practices.
That's great to hear, Kathryn. And we are definitely going to dive into the ESG reporting aspect of it. But I guess taking a step back, in the Opta Sessions podcast, you mentioned that there were global inflows of $71 billion into sustainable funds in the second quarter of this year. So ESG is booming right now. And your early commitment to the space was certainly a wise move. Now that we're moving towards the end of 2020, what are some key trends that you expect to see in 2021?
Yeah, and I'll say that even in the third quarter, that only increased more. So according to Morningstar, there's now, I think, $1.2 trillion in funds that are labeled, ESG in one form or another. So I think that the pandemic has certainly only encouraged additional interest in ESG, but we don't see the interest abating anytime soon. I think the open question is can we continue on this, the trajectory that we're on now, which would frankly be pretty difficult in terms of growth. But we do see ESG and sustainability definitely continuing as a key attractor of AUM going into 2021. In terms of specific trends, though, I would see a very strong and continued interest in thematic investing. So environmental investing, diversity and inclusion-oriented investing, especially in the wake of the Black Lives Matter movement, biodiversity. These are all things that resonate with individual investors, and perhaps even more so because of COVID. The second trend that we would expect to continue is this sort of barbell between divestment and avoidance versus, hang in there and try and change things. And there's a divestment argument that we see as being very popular with individual investors and certainly some pensions and endowments. It makes an investor feel good to not have exposure to oil, for example, in a portfolio. Additionally, many investors also believe that oil represents a risk that would ultimately be a drag on return. So it's not just a feel-good thing, but there's an actual investment argument at work there too for many investors. On the other end of the barbell, though, are some of the world's largest investors that are simply not able to walk away from big parts of the market by virtue of the fact that they essentially own large chunks of the economy. And so the good news is that because of their size, they're able to push companies toward transformation. And when we talk about real economy impacts, this is what we're talking about. But again, this trend between divest versus invest and try and change is something that's been with us for a while that we see continuing. And finally, I would say just the overarching theme is that ESG has simply become the price of admissions in many parts of the market. And this has been true outside of the US for quite some time, but we now see it really coming into the US, both in the institutional space as well as in retail and platform space. And I think that this is only going to continue as we see this generational transfer of wealth, where subsequent generations clearly are much more informed and are very interested in voting with their dollars about what their feelings on environment and social causes.
That's a perfect segue. So let's talk a little bit more about your philosophy for impact investing. As someone who has worked at Barr & Rosenberg, what's an effective way to measure impact? In a previous conversation and earlier, you mentioned KPI reporting. So let's start with what KPI reporting is. What are other ways that one should measure and think about impact? What are people missing?
Yeah, so let's start with the term KPI. When we refer to KPI, it's this type of information is called by a number of different names, but we mean a KPI as being an observable attribute of a company, like number of women in management, carbon emissions as expressed in tons, number of workplace fatalities, whether or not a company is a UNPRI signatory. So the key point when we use the term KPI is to distinguish this observable characteristic from an ESG score. Scores that are produced by any number of data providers are made up of KPIs, but also depend on a number of assumptions that make them helpful as an overall summary view of a company's commitment to ESG, typically within their operations. But scores in isolation are very difficult for the average investor to kind of make sense of. There was a study recently that was just looking at the surprisingly low correlation between the ESG scores of different data providers. And I think that, while it certainly is explainable, it's not confidence building for the average investor. And so when we think about score, we strongly believe that score is a helpful thing when it comes to portfolio construction. It helps us really articulate, if you will, the relative importance of these different KPIs within our view of a company. So for example, data privacy, we would see it as being far more important for a tech or a healthcare company as opposed to a company that makes tires for cars or baby diapers. So when we think about what matters from a risk and reward standpoint, stock picking standpoint, portfolio construction standpoint, we're very interested in using scores in what we do. But when it comes to reporting, we really believe that KPIs should be the focus because they are so tangible in the minds of investors and ultimately represent the most granular and real view of company behavior and decisions on the part of companies. So for reporting to be effective, we strongly believe that a report that talks about companies in the portfolio having more proportional women on the board, fewer supply chain incidents, no on-site accidents, that's a lot more helpful than saying, hey, your portfolio gets a score of 75 as opposed to a benchmark score of 70. So in terms of relating to impact, which I think is the second part of your question, let me take a step back for a second and define what we mean by impact. So we define impact as investing in pursuit of both measurable social or environmental outcomes and competitive return. So it's this two-pronged approach to investing. And when we talk about impact, really irrespective of asset class, we look for evidence of a couple of things, including intentionality, which is simply the idea that the company or the investor behaves in a way or initiates investments with the intent of creating positive outcomes for society or for the environment. And additionality, which is the idea that the action on the part of companies or the investment on the part of investors works to meaningfully increase positive impacts within society. Ideally, we would want to see that an investment or an action is impacting the largest, number of people or the largest, portion of the environment possible. But it really is this idea of intention and addition that's important to the concept of impact. We tend to use the UN Sustainable Development Goals as a framework. It's UN SDG is the acronym that we use. And so when we talk about impact, we often talk about alignment to the UN SDGs. My own background being in public equities, I will volunteer that there is a debate as to whether or not we can achieve impact, real impact within public equities. And I would say historically, most people associate impact investing with private equity or even to a certain extent with fixed income investing. But we would argue that yes, it is absolutely possible to achieve impact within public equities, and we should make this part of our mission as investors. When we think about impact, we can think about direct impact within equities, and that is voting and engagement. So here we are interacting directly with management or with boards in an effort to get them to change or augment what they're doing. And so KPI information is used here to talk with management about tangible goals for progress within their firms. So we can also think about indirect impact, which is the practice of investing alongside companies that are making goods and services that are positively aligned to the UN Sustainable Development Goals. And the way that we assess that is using the KPI of revenue. What portion of the company's revenue is in those products and services that is positively aligned with those environmental and social goals? So in both instances, we've got scores and then we have KPIs that we can use either to an ESG end, which is subtly different than an impact end. The impact end really requires us to translate all of this into what is the real economic change that we are encouraging or evoking by virtue of our investment practice.
That's great, Kathryn. And I really like what you're emphasizing with focusing on tangible results through those KPIs rather than the ESG scores, because I feel like a lot of advisors and investors do get a little lost in all those different scores instead of focusing on the actual outcomes. So that's great insight. Pivoting slightly, you also founded Aquanos Collective, which focuses on water infrastructure and technology. So could you tell us a little bit more about this and how does this maybe fit into the rest of the ESG investing initiatives?
Sure. So Aquanos Collective is the result of a long period of study for me that has focused on water as an ESG and impact theme. And the name Aquanos, roughly translates from Latin as aqua, meaning water, and nos as either we or us in Latin. So Aquanos really is the study of water and societies. And, water technology right now is at a very, very exciting point when we think about how it is poised to address a lot of the challenges that we face when it comes to water stress and water risk. But I will caution that technology alone is not going to save us. We really need in all of these arguments about climate change, it really is water that is the result of climate change, and water stress and water risk is affecting us immediately. My own perspective is very much colored by the places that I've lived. I live in California right now. We have lived in Australia as well. And so both of these places are, very much affected by drought and the impact that drought has on local economies. But, we really don't have to leave our own country to find almost the opposite example going on, finding flooding, seawater incursion, other water problems that are costing our economy millions each time one of these big hurricanes hits the Gulf. So we're seeing greater extremes of wet and dry all being driven by the warming of the atmosphere. I think it's very important too that we don't ignore racial inequality that's baked into water problems. Flint, Michigan, California's Central Valley, forced migration in other parts of the world like Nigeria, that it has conflict, water conflict at its origin. The S dimension, the social dimension of water, is very, very tightly woven into the E dimension of water, with race and gender kind of at the core of this intersection. So water is an issue that goes, well past a simple E designation on the ESG scale. From an investment standpoint, we think there's a tremendous opportunity for downside risk protection by thinking about ways we can future-proof investments with respect to water risk. Real estate is an obvious example, but supply chain is another thing that I've spent a lot of time thinking about recently. These are all areas of risk that have to do with water and water-related problems. On the other side of things, I think there's a tremendous opportunity for companies that will enjoy a tailwind because they are anticipating an environment that is hotter, drier, or wetter in certain cases, with more limited resources, potential regulation. Again, a lot of focus has been on carbon to date when we think about environmental in the ESG, but it's really water that's going to make or break us as companies, as humans, as a society immediately. And so I think water, I will advocate for water as being really central in ESG thinking for any investment discipline.
Wow, Kathryn, you were involved with so many diverse initiatives to change the world. And at this point, Emily, myself, and the listeners are probably thinking you can do anything. So in the midst of all of this, what's next for you?
So we are really, really committed to convincing investors and pushing companies to take a true impact view of their activities. This is what connects investments to outcomes in the real economy. This is how we make our companies more resilient and grow our economy. So when we talk about impact, we need to be mindful of what can be achieved within any given asset class. And this matters because the levers that are at our disposal are different if we're talking about sovereign debt, as compared to public equities. But we argue that all investing should be approached with this impact mentality, knowing that the way that we achieve impact is going to be a little bit different in different asset classes. So as investors, again, independent of asset class, we can collectively support company management that is legitimately trying to transform its business for the better. This comes through an engagement, and if you're an equity owner, through voting. But this may mean putting less emphasis on quarterly earnings, for example, actively working to reject what is often referred to as short-termism within our business. And this is a big challenge for our industry because a lot of the short-termism is so completely entrenched in our daily workflow. But to bring about real change in the economy, we need to work together to turn this very big ship, and that's going to mean doing things differently. I would say also within an impact mindset, we can all advocate for greater transparency when it comes to insurance and banking information. So there's still a great deal of opacity when it comes to the activities of what is being insured and what is being financed by whom. If we're really serious about changing business practices, we need to know how and what is being backed financially. And that simply means more data and more sunlight applied on that data. So two other, I think, really important areas of focus for us in the coming year. The first is working toward finding solutions for race and ethnicity data. And this is a very hard nut to crack for some really good reasons. But under the heading of you can't manage what you can't measure, we absolutely, as a society and as an economy, must make progress on this. The second thing that's also really exciting to us in the coming year is what we're calling our New Voices series, that we're rolling out in January. This is going to be a series of videos that feature the next generation of consumers and investors, college age people, talking candidly about what they look for in products and brands, what sustainability means to them, what kind of companies they would like to work for. And this is a very well-informed group with very strong opinions. And as investors, I think we're going to be wise to listen to what this next generation has to say. We'll host these videos on our website, and I'm sure we'll do a little announcement on LinkedIn. So if you're following us, please look for that announcement. But it's a really fun project for us to work with college students. But again, I think it has real investment merit.
Great. That sounds very exciting, and we will definitely be keeping our eye out for your New Voices series. So pivoting now, as a successful woman in impact investing, what advice or resources would you give to people who want to make the same jump?
Yeah, I think the answer to this is a little bit dependent on where you're coming from and what your experience with investing is. But again, at the core of impact are two concepts. The first is societal or environmental gains, and the second is financial gains. So we can't have impact, one without the other. It's the combination that makes it different than other traditional investing on one end of a spectrum or philanthropy on the other end of the spectrum. So for those who are newer to this space, I would suggest start by focusing on one or two key themes that really resonate with you, and approach each of those themes through both a traditional investment lens and, an ESG and impact lens. And then, alongside of that is read everything that you can on those themes. So there's a ton of information out there, which is really overwhelming. But if you narrow your scope down small enough, you will have plenty of reading, but it will become very manageable, and you will quickly become expert in a very narrow part of impact investing. And I think it's really nice to start in that way and then to kind of build on that. I would also say that talking to others, either in a formal mentoring situation or just finding other people with the same interests. I think that what you'll find is that people love to talk about things that they have a passion for. And so by approaching people that are already in impact investing, many of us who have been doing this for a while are overjoyed that there is such interest. And we're very happy to share our thoughts and our advice, such as it is. But really don't hesitate to reach out to other people, even if you feel like you're coming from a little bit of a position of insecurity.
Well, thank you for that advice and encouragement, Kathryn. I'm sure that's going to be very reassuring for some of the people who are a little hesitant about making that leap. And I guess since it's the holidays, let's wrap up this episode with a more festive question. What is the best $10 that you have spent on a holiday gift?
This is a really good question, and the $10 presents a challenge. So I will, at this point, fall back on my value investing roots and recommend a book, because a book represents many hours of enjoyment in the numerator for not a lot of cost in the denominator. I'm not sure that this particular book can be gotten for precisely $10, but I bet it will be close. So the book that I would recommend is Richard Powers' book called The Overstory. This book won the Pulitzer Prize for Fiction in 2018, and it is an epic novel, and I don't use that lightly, with a very heavy environmental undercurrent. And in fact, it uses trees as this, storytelling way to, provide connective tissue within the storylines of the book. But it is the writing itself that is shockingly beautiful. So the subject matter definitely appeals to me as a person who loves the outdoors and who loves environmental themes, but it is just such a beautifully written and well-crafted book. I think it would make an excellent gift for almost anyone.
That's great, Kathryn. You just helped me complete my holiday gift list here. I was wondering what I should get for certain family members, and I think they will absolutely enjoy the book, as will I. So thank you for that. Thank you for joining our Women in Impact series to share your important work with ESG analytics and measurement, Kathryn. Listeners, please visit justinvest.com to access all of the resources mentioned during this interview and to learn more about investing with intention. You can also follow us on LinkedIn, Twitter, and Facebook. This is a wrap for us, and until next time, let's continue to win impact together. Investing done just right with Just Invest.